Welcome back. Let's look at business now. The Central Bank's Monetary Policy Committee met this afternoon to review the country's monetary policy as banks withdraw notices of higher interest rates. And despite pressure from the government, the bank retained its benchmark lending rate at 11.5%. Adelaide Changole tells us more.
The second half of the year has witnessed an unprecedented amount of central bank intervention in the market as the CBK worked to tame the runaway shilling, which was approaching the historic low of 107 shillings to the dollar. Combined with a 300 basis point increase in the benchmark lending rate in June and July to 11.5%, the central bank also stepped up its mop-up operations to reduce liquidity and boost the struggling shilling. As a result of the interventions, the shilling stabilized at the 102 shilling mark, while the country's inflation levels have remained well within the 2.5 to 7.5 CBK target. But as stability emerged, so has pressure on the central bank to unwind the tightening stance.
Since they have room with respect to the interest rates, with respect to the inflation, which is far much below the target, there is obviously room to unwind this situation gradually in a way that we continue to have, liquidity in the system without, creating any, challenges.
However, the central bank has shaken off this pressure, retaining the benchmark rate at 11.5% for the fourth month in a row as it seeks to anchor inflation expectations, which have jumped from 5.92% in September to 6.72% in October. The bank also sought to ensure the stability of the exchange rate, particularly given the falling treasury bill rates, which have fallen from 23% to 9.67% last week.
The last thing we want is a sudden instability in the other markets.
With the decision, CBK appeared to have read from the IMF playbook, which had cautioned against knee-jerk reaction to the monetary policy, saying there was no need to adjust rates downwards, only to adjust them upwards again in a few months.
So if interest rates go down very quickly and then they pick up again, that will create a lot of uncertainty and damage to the credibility of policies.
However, the move to retain the rate at 11.5% will come at a steep cost to manufacturers who have had to contend with higher borrowing rates owing to the upward adjustment of the KBRR, a move that has curbed credit appetite and inhibited growth of the economy. The World Bank now wants the government and the central bank to clearly define their strategy in this high interest rate environment and their planned end game, as opposed to leaving Kenyans and businesses guessing.
For a manufacturer, and he'll tell you he's interested in working capital. He can decide just to close down and put his money in the treasury bill rate.
Adelaide Changole, KTN Business.